Inflation just hit 4.2%. That's the highest reading in 3 years. And while everybody's staring at the gas pump, there's a second bill coming that almost nobody sees. Inflation quietly shrinks your insurance. Not the premium, the protection. Here's the number that should bother you. Roughly 75% of commercial properties in this country are underinsured by 40% or more. Most of those owners have no idea, and they won't find out until the day they file a claim. Stick with me to the end because the last part is a piece of coinsurance math almost nobody checks, and it's the part that decides whether your next claim pays in full or pays 75 cents on the dollar. If you own a business, a building, or a fleet, this one's for you. Let's get the numbers on the table first because they tell you how fast this is moving. The May inflation report came out yesterday. Consumer prices rose 4.2% over the past 12 months. That's the hottest reading since April of 2023, more than 3 years. And look at the speed of the climb. In January, inflation was running 2.4%. February, March, April, May, and now it's 4.2. It nearly doubled in 4 months. That kind of acceleration changes how you should think about every dollar figure in your business, including the ones printed on your insurance policy. The big driver is energy. Gasoline is up 40.5% from a year ago. It jumped 7% in the month of May alone. The national average is sitting around $4.15 a gallon, and diesel is averaging $5.21 nationally. Here in Florida, we're running a little under that, about $4.94 for diesel. But if you run trucks, crews, or deliveries, you don't need me to read you these numbers. You've already seen them on your fuel card statement, and they're showing up in every quote your vendors send you. Now, one honest caveat, because I'm not here to sell you panic. Energy did most of the damage in this report. It drove more than 60% of the monthly increase. Core inflation, which strips out food and energy, is running 2.9%. So no, this is not 2022 all over again, at least not yet. But energy doesn't stay in its lane. Fuel is baked into every delivery, every building material, every service call. When diesel costs $5 a gallon, lumber, drywall, roofing, and labor all follow it up. And that's exactly where your insurance problem starts. Here's the connection most owners never make. Your insurance policy is written in fixed dollars. The building limit, the business income limit, the equipment schedule. Those numbers got set on the day the policy was written, and most of them haven't moved much since. But a claim doesn't get paid in old dollars. A claim gets paid at today's costs. Today's lumber, today's labor rates, today's lead times. Every month inflation runs, the gap between the number printed on your policy and the number it actually takes to rebuild your business gets a little wider. You don't feel it until you file. And the data on that gap is ugly. Appraisal firms that go out and physically measure commercial buildings found that close to 90% are valued below what they'd cost to rebuild. 68% of buildings appraised were underinsured by 25% or more, and nearly 1 in 5 was underinsured by a full 100%, meaning the real rebuild cost was double the policy limit. Read that again. 1 in 5 owners would get half a building back. And those studies were done before this latest run of inflation. It's worse today, not better. How does a smart owner end up there? Nothing dramatic happens. You set the building limit when you bought the place, maybe 8 or 10 years ago. Every year the renewal shows up, the premium gets paid, the folder gets filed. Meanwhile, construction costs went vertical. In one recent year, construction cost inflation hit 19%. 19 in a single year. Your limit moved 2%, maybe. Nobody made a mistake. Nobody did anything wrong. The number on the policy just quietly went stale while the real world repriced itself around it. Some policies have a feature called an inflation guard. It bumps your limit automatically every year, and agents love to point at it. Here's the catch. Most inflation guards run at 2 to 4% a year. Construction costs have been climbing a lot faster than that for years. So the guard helps, but it falls a little further behind at every single renewal. It's a seatbelt that's stretched. It feels like protection, and it'll still let you hit the dashboard. Now the part I promised you, coinsurance. And I'll keep the math simple. Most commercial property policies have a coinsurance clause, usually 80 or 90%. It says you must insure the building to at least that share of its real value, or the company penalizes every claim you file. Say your building would really cost $1 million to rebuild today. 80% coinsurance means you need at least $800,000 in coverage, but your limit is $600,000 because it was set years ago. 600 divided by 800 is 75%. So now a kitchen fire does $100,000 in damage, a claim you're covered for on paper, and the policy pays $75,000 minus your deductible. You eat the rest. Not because the claim was denied, because inflation dragged your building out from under your own policy. It doesn't stop at the building. Your business income coverage, the part of the policy that replaces your revenue while you're shut down after a loss, is built off a worksheet, and that worksheet uses last year's numbers. Think about what's happened since. Your revenue is up because your prices are up. Payroll is up. Rent is up. Materials are up. If your business income limit still reflects what the business looked like in 2024, it'll run out months before your reopening date does. And running out of income coverage in month 7 of a 9-month rebuild is how good businesses die. And the rebuild itself takes longer now. Materials sit on back order. Good contractors are booked out for months. Permits stack up at the county. A rebuild that took 8 months a few years ago can easily take a year or more today. So you've got longer downtime at higher monthly costs against a coverage limit that was sized for a faster, cheaper world. That's 3 gaps stacked on top of the same claim, and they all pull in the same direction, against you. If you run vehicles, there's another front. Diesel at $5.21 doesn't just hurt at the pump. Parts prices, used truck values, and repair labor are all climbing with it, which means the cost to repair or replace your vehicles after a loss is climbing too. Here's the question for your fleet. If your commercial auto policy carries stated values on your trucks and trailers, when did anybody last update them? A stated value from 3 years ago can leave you thousands of dollars short on the day a truck gets totaled. And trucks get totaled. Same story for everything inside the walls. Contents, tools, machines, the whole equipment schedule stapled to your policy. Owners set those values once, usually the day they bought the coverage, and never touch them again. Now try replacing a commercial oven, a skid steer, or a server rack at today's prices with a limit written in 2022. The schedule says one number, the invoice says a much bigger one. The difference comes out of your pocket at the worst possible time. Now here's the move I'm begging you not to make. Inflation pushes premiums up too, so right about now a lot of owners look at the renewal bill and start shaving. Lower the limits, raise the deductible, trim the coverage, get the number down. I get the instinct, but cutting limits during high inflation is exactly backwards. You're shrinking the policy at the precise moment the cost of every claim is growing. If the budget's tight, there are smarter places to find the savings. Limits are the last thing you touch, not the first. So here's the whole trap in one sentence. Inflation doesn't cancel your policy, it hollows it out. The premium still gets paid. The certificate still looks fine hanging on the wall. The denial letter never comes. The check just comes up short. And you find out on the worst day your business has ever had, when there's nothing left to fix. Here's what to actually do about it, and it's one conversation, not a project. 3 moves. 1. Get a current replacement cost estimate on your building. Not the market price, not the tax assessment, the cost to rebuild it today at today's prices. 2. Find the coinsurance clause in your property policy and ask about an agreed value endorsement, which switches that penalty off entirely. 3. Redo your business income worksheet with this year's revenue and this year's costs, and make sure both the limit and the time period match the world we're actually in. Every one of those is cheap. Finding the gap inside a claim is not. My name is Dennis Hendrickson. I'm a licensed insurance broker in Sarasota, Florida, and this is exactly what I do for business owners. Pressure test the numbers on a policy against what things actually cost right now. If your limits haven't been reviewed since before this inflation run started, it's worth 15 minutes to find out where you stand. My contact information is right down in the description, and the first conversation doesn't cost you anything. If this was useful, do 2 things. Subscribe, because every single day we break down a real business story and what it means for your bottom line, the practical version, not the hype. And send this one to a person who owns a building or runs trucks and still thinks their coverage is fine. You'll be the one who saw it coming first, the friend who catches the thing everybody else missed. Hit share, drop it in a text. Inflation is up, and most coverage hasn't caught up. Make sure yours has. I'll see you tomorrow.